Good morning, everyone. I hope you can hear me okay. Thanks very much for joining us. I see that we've got a number of participants on the line now. My name is Grant Mundell, Investment Specialist with Equity Trustees, and we're here today to present on the last 6 months. What's been happening in markets. It has been a fairly volatile and turbulent time, but also to give an outlook in regards to equity markets and fixed income markets, and also answer any questions that you may have. So thank you for joining us, and apologies for the delay in terms of the presentation that was postponed from a week or so ago. So I'm just going to take you through effectively to start off with, for those of us who don't know us, in terms of the Equity Trustees Asset Management team. It's an experienced, stable and growing team. It combines of investment advice, but also implementation across multiple asset classes, and is headed by Darren Thompson, the head of our asset management team, and Chris Haynes, who heads up our equities team. So you can see there across the board, it incorporates not only Australian but international equities through our JV with 8 Bays Investment Management, and also defensive asset classes, which include our cash management fund, also our diversified fixed income fund, and our mortgage income fund. Just to give a little bit of an update as to what's been happening to the asset management team over the course of the last 12 months. We're seeing continued growth in assets under management. Performance of the funds have been and the products have been good, and we've had some good client wins. What's been really pleasing is that an independent asset consultant, SQM, has rated 5 of the different products. 4 of those products, 3 of which are Australian equity products, and 1 the mortgage income fund, were all given a superior rating, or 4 out of 5 stars. And the newly launched EQT 8 Bays Global Fund was given 3.75 stars. And that's a real, it gives real credit and credence to not only the team and the experience of the team, but also the processes and the performance of those particular funds. Also, the relative outperformance in Australian equities has been exemplary, and I'll show some numbers later on, but according to the latest Mercer ranking for the period up to 30th of June, performance for over 1 and 3 years was in the top quartile, over 2 years was at the upper echelon of the second quartile, and was in fact across 80 core Australian equity managers, was ranked 9th in terms of performance over that 3-year period for the EQT flagship fund. Also, whilst fixed income markets have had a tough start to the year and a tough last 6 to 12 months, Alistair, who took over in a full-time capacity as head of fixed income, has relatively outperformed his peers over the course of the last 6 to 12 months as well. And lastly, we've really consolidated our incorporation of responsible investing within our asset classes, in particular through Australian equities, with the appointment of our General Manager of Responsible Investing, Delan Ashton. Delan has come on board to, reinforce and enhance a number of the processes that we already had in place, but further communicate on an external basis, work with the analysts around ESG and responsible investing, and has conducted a number of things, such as our signing of the United Nations Principle of Responsible Investing, and implementation of our responsible investing framework, which is now on the website. So in terms of the market, after a really strong FY21 period where markets obviously bounced very strongly, and that was really aided by very low interest rates, very strong fiscal stimulus from governments coming out of COVID, and also the very strong medical breakthroughs. FY22 saw most asset classes actually decline, with the exception of a few different commodities which were impacted by supply issues. So you can see across the board from bonds, sometimes FX, and an equity market perspective, indices were down. In particular, the last 6 months to the 30th of June, they were hit quite hard. And the key reason really for that, let us talk about lettuce. You've all seen through the headlines, obviously, that inflation has been effectively the key talking point, not on news headlines, but I'm sure between friends and family, but also in investment markets. And really this has occurred for a few different reasons. Firstly, from an energy perspective, obviously the Russia-Ukraine conflict has limited gas and oil supplies out of Russia. Ukraine is also a major exporter of soft commodities. We've also seen an underinvestment in traditional energy as we're transitioning to renewables. So these supply issues have exacerbated the problems. Other issues such as flooding, supply chain issues off the back of COVID, and the extended COVID lockdowns in China have elongated those supply chain issues. So to get hold of materials, inputs, chips or whatever it might be, has all taken longer than expected, and the costs in transporting those have been quite high. When you couple that tight supply with strong demand, that's what's really led to this inflation. And coming out of obviously the COVID period, there was very strong pent-up demand. People hadn't been out and about and doing things. Consumers were actually flush with cash because of a lot of the government handouts. So when input costs started rising and consumers were asked to pay for more, they actually did. And that's what has seen headline inflation rise so much. The last point being that labour markets have been very tight in a lot of places around the world, and that's now starting to impact in terms of wage pressure coming through as well. The important point to note, and what really affected markets in the second quarter of this year, were that inflation expectations started to rise. And that really caught the attention of central bankers. And the concerns were there that if you start to get a wage price spiral risk, then you can start to get inflation out of control. So that meant that central banks had to act faster than they initially were indicating. And this chart just sort of shows that you can sort of see on the right there, rates have had to increase very quickly over the course of the last 3 to 4 months in particular, and expectations for rates going forward will continue to increase as well. So the other point to make is that obviously rates were very, very low, and those emergency settings were arguably kept in place for too long. And central banks also thought that inflation initially was transitory, and they changed their criteria for inflation, wanting to see it sustainably within those sort of 2 to 3% bands. But inflation started to rise very, very quickly, and for the reasons explained on the slide before, have really ramped up. And therefore, central banks have had to really depress the demand side of the equation, because a lot of that supply side they can't do anything about. So you're now seeing them having to play catch up in a very, very quick period of time. We expect that rates around the world will continue to increase in the second half of this year, and that will start to slow economic growth and lead to higher unemployment. Higher rates effectively has led to lower asset values. So we've seen that asset prices have derated on the back of the repricing of rates. The chart on the bottom left there shows equity market price to earnings multiples, and this is probably the key valuation metric for equity markets. And you can see both the blue line, which is developed market equities, and the orange line, which is the Australian share market, have decreased quite a bit from over the course of the last sort of 12 to 18 months. And the chart on the right shows that the black line being really 10-year break-evens, which is a measure of inflation expectations, that rose. Then bond yields started to rise, and when bond yields rise, the capital value of those bonds start to fall. And because yields were quite low, they weren't enough to offset the capital for that particular point in time. In these sorts of markets, we'd highlight that valuation discipline is extremely important to protect capital. You would have seen parts of the equity market that were very highly valued have fallen a lot. So it was really important to maintain a valuation discipline, and that's something which has led to some of our outperformance in our Australian equity markets or products. So in terms of the economic growth outlook, economic data has generally been sort of okay. We are obviously seeing points of slowing, but it's really the future indicators that are pointing to a fall. You can see on the chart on the bottom left there, consumer confidence is falling, and the chart on the right shows that new orders is falling, because we have seen a build-up of things like inventories. So the market typically prices in events in sort of 12 months into the future. So already probably to some degree pricing in a mild recessionary environment. And really the question now is going to be, how bad is that economic downturn going to be? And this chart just shows that you can see that global economic growth forecasts by the OECD between December 2021 and June 2022 have pretty much all been revised down. And for global or world economic growth, for 2022, it's fallen in that 6 months from 4.5% to around 3%. We saw the ASX 200 or the Australian share market actually, it's relatively outperformed over the course of the first 6 months of this year. And in particular, up to 31st of May was a massive relative outperformer, but fell away in June. And the key reason around that was because of these rising interest rate expectations, the market's concern shifted from inflation to future economic growth. And that started to impact on commodity prices and commodity markets. And we've got a large resource sector. And also what that would mean for asset quality for the banks. And effectively, so both those large sectors in the Australian marketplace got sold down, as did the energy sector. Going forward into August, which is the Australian reporting season, we've already started the US and European reporting seasons. The numbers should be okay, but it's really going to be the outlook statements for FY23, which are going to be the focus and of the market. So in terms of that, and looking at Australian equities in particular, as mentioned, just to highlight the performance of our products, the fund performance of the EQT flagship fund. What's been really pleasing is the gross active return at the bottom there, highlighted. That's our relative outperformance versus the benchmark or the ASX 200 accumulation index. And what's been really pleasing, due to our quality at a reasonable price approach, has seen really strong outperformance over the last 1 to 3 years in particular, which has been led by Chris Haynes. So that's really pleasing. Obviously, markets are down, which is never easy to see, but the active outperformance has been strong. And to give you a little bit of a hint, we are a fundamental bottom-up stock picker. We have a portfolio in the Australian equities fund of around 35 stocks. So we place bets effectively, overweight or underweight stocks to own. And this just shows where what sort of things led to some of our performance. So after pay, we actually had strong attribution to our performance relative to the index because we didn't actually own it and it fell away a lot. Atlas and Ramsay did quite well. They actually got taken over or received takeover bids, which saw strong outperformance for them. And Origin Energy has sort of benefited from the higher oil prices that have come through. Wesfarmers we owned in the first half of FY22 and then sold around the February earlier this year, and that's worked out well for us as well. And you can see there was also detractors. We're not going to get everything right, but detractors to the performance. By way of example, we've had bets in things like Origin and Santos. We've been overweight, we were underweight Woodside, and that has detracted. But we would have made that up at least through our Origin and Santos bets. And other stocks that have fallen away, Sydney Airport also received a bid. Northern Star, a gold company, has also underperformed a little bit more recently as well. So we just highlight in terms of the economic slowdown and the focus of the equity market going forward. But when you get a combination of tighter financial conditions, slower economic growth, that's going to lead to earnings downgrades. And really up to probably 30th of June, we didn't see a real change in terms of future earnings. And that's indicated in the chart there by the blue line. So that's been the real interesting factor. So we do expect earnings to be downgraded by analysts in the market. The market acts in advance of this, so it's already pricing in some of these downgrades. And in July, we did start to see some of those downgrades come through of around 4 to 5% for the market, mainly from energy and resource stocks as commodity prices were downgraded. Our view would be in an environment of falling economic growth and earnings downgrades, you want to own quality companies or quality securities. And they're companies effectively that are well managed, strong balance sheets to withstand those rising interest costs, have pricing power to be able to pass through those rising input costs, and operate in strong industry structures with strong growth characteristics and hopefully market-leading franchises. Also something just to be aware of as the market is trying to figure out whether we're going to see a mild downturn or a harsh downturn. Corporate and consumer balance sheets are generally in pretty good shape at this particular point in time. Following the COVID resurgence, savings rates for consumers have been quite high. That's the chart on the right there. Balance sheets are quite strong. Corporate balance sheets are actually probably the strongest in about 30 years, and that's the chart on the left. And we did see a lot of corporates lock in low borrowing rates when rates were much lower. And whilst a little bit of a lagging indicator, unemployment remains low at this particular point in time. and we still do have high job vacancies. So that should support the job market in the near term, albeit that will slow down going forward. In terms of July, we actually saw a bounce back in the markets, which was interesting, and just wanted to highlight what happened there. We have obviously started to see, as mentioned, commodity prices start to fall. We're starting to hear about supply chain pressures easing, and even a little bit in terms of job openings are starting to sort of slow as well. And what that means is that perhaps the worst in terms of the inflationary signs are behind us. So the market took that as a bit of a positive. If inflation pressures aren't still going up, then rates won't have to go up as much. So we did see effectively bonds rally. They rallied, as did equities, and yields effectively fell. So that's something we're going to be keeping an eye on in terms of that narrative in the market. And from an Australian equities perspective, we would highlight, however, that obviously, as mentioned, in a period of falling earnings, there are certainly still risks around, and it makes it hard for the equity asset class to really outperform. So the magnitude of those downgrades is going to be really important to watch. Inflation pressures are still coming through in Australia. We're probably to some degree 6 months behind places like the US. The economy will slow, and obviously the housing market, as we've heard, which many people are leveraged to, is starting to slow as well. Having said that, commodity markets, whilst they have come down, the fundamentals are quite tight. And as China re-emerges or reopens out of their COVID lockdowns, we should see stronger demand out of the Chinese market for commodities. The dividend yield for the Australian market looks very attractive. It's back to sort of more normalised levels, and it's very attractive versus other international equity markets. And obviously, once you gross that up for franking, it's even more attractive. And the market, as mentioned previously, is derated. So it's actually back to sort of relatively good value at this point in time. And some of the fundamentals around the consumers and corporates, and also from a government perspective in terms of trade, are quite positive. The last point I'll just sort of make is that, as we know, with equity markets, they can rise and fall. So volatility and fluctuations are normal, effectively. It's really important to, when thinking about growth assets or equity markets, to take a longer term view. The other factor about that is if you're selling after a market fall, then you're crystallising in those losses as well, and you don't take advantage of a market rally. As example, by the way of example, the US equity market's up 12% from the lows earlier this year. Diversification remains an important thing to be able to limit the volatility in your portfolio, and everyone's different in terms of their investment objectives, their risk appetites, their time frames. So it's important to get the appropriate advice for you. In terms of cash and fixed income, well, the outlook for cash is starting to improve. As interest rates go up, the returns that you'll get on the cash management fund will start to increase. And as mentioned, because of that inflationary environment, the Reserve Bank of Australia is starting to front load the rate hikes, and we're starting to see them come through quite quickly and expect them to continue in the second half of this year. The current market pricing, is taking it up towards sort of 2.5% to 3% over the course of the next 6 to 12 months. And also banks, they're not getting the cheap funding from the Reserve Bank anymore, and so therefore they've had to lift their deposit rates for consumers to get those deposits to be able to lend those out or offer them out to borrowers effectively. So deposit rates are starting to increase as well. In terms of fixed income, it was a really tough last 6 to 12 months, worse than a lot of other periods in history. And that was really because we came from a very overvalued time of very low bond yields. And as we've seen that inflation come through, as mentioned, yields have risen, but the capital value of those bonds have fallen quite considerably. So a performance there in terms of the index for fixed interest markets worse than a lot of other major pullbacks in the market in the last 30 to 40 years. The chart on the bottom right, however, shows that for the Equity Trustees Diversified Fixed Income Fund versus a lot of our peers, our performance was a good one. So yes, the product returns fell over that 12-month period of time, but we did a lot better than others, and that's a real credit to Alistair and and the quality nature of the portfolio that he holds. That was the bad news. The good news is that the outlook for fixed income now looks a lot better. We think that going forward, returns should be positive, and over the course of the next 12 months should certainly, as inflation starts to moderate, improve. So you're starting to get a better yield. Obviously, 10-year bond yields are now sort of just over 3%. And depending on the change in those yields, we think you can sort of get between sort of 1 to 5% total return effectively based on where markets are currently. So that's the outlook is certainly been improved for fixed income after it looking, having very muted returns for a good last couple of years. Also within the fixed income portfolio, credit is something that we can we acquire within the portfolio, and spreads have widened significantly. Obviously, that's indicative of a slowing economic environment and corporate defaults effectively. But leverage in the corporate space is actually pretty low. So we therefore think that credit is actually pretty well placed at this particular point in time, and the default rates should be quite low for investment grade credit. To give you an indication of how that sits within the EQT Diversified Fixed Income Fund, you can see in terms of the sector allocation within the portfolio, we're overweight that investment grade corporate bonds at about 17.6% relative to the benchmark. So we think that will be an outperforming part of the fixed income market. And you can see the credit quality of the portfolio is very high as well. So it is a high quality portfolio. Also, within the defensive asset quality or asset suite, our mortgage income fund has been a really strong performer over the course of the last 1, 3 and 5 years in particular. It's a capital stable product, very conservatively managed, and is currently sort of gross yield of around 4.1%, and it provides first mortgage secured loans out to various parts of the property sector. Very conservatively struck in terms of loan to value ratios, and has been a really strong performer in tough markets, especially over that last 6 to 12 months. So in summary, what we'd highlight, and we have been saying since the beginning or end of last year really, was the portfolio returns this year were going to be lower. Capital return was going to be certainly tougher, and volatility was obviously going to be higher. As interest rates move up, the economy will slow, and we do think those earnings growth rates will fall, and therefore diversification remains very important to reduce some of that volatility. It's really important also to retain a medium to longer term time frame, especially when you're holding growth assets or equities effectively, so you can look through those short-term bouts of volatility and have enough cash to suit any of your needs over the course of the next 1 to 2 years. Defensive asset class returns had been very muted, but now are actually starting to improve. So that's going to, from a more diversified portfolio perspective, just give it a little bit more cushioning in terms of total returns, we hope, going forward. Equity valuations have derated. We do think there's probably less room to move higher in terms of a massive re-rate, given we don't think interest rates are going to be moving really low in any short period of time. Therefore, the focus is really on that earnings and earning stability going forward. And in that sort of environment, active management and picking the right sort of stocks with a quality focus, where you've got good valuation focus as well, becomes really important to drive that relative outperformance. In terms of our asset allocation positions, over the course of the last sort of 12 to 18 months, we've been tactically underweight fixed interest and more overweight other things such as the mortgage income fund and Australian equities. Most of the asset classes we're probably more neutral on now, and fixed interest has probably been the major move, where we sort of see that back at sort of fair, closer to fairer value and starting to deliver reasonable returns, and therefore that's moved back to a neutral sort of stance. And from an equities perspective, and probably broader asset classes, income is recovering or has recovered. And remember, is an important component of your total return, especially from an Australian equities perspective. You can be getting, depending if you're a tax exempt entity, 5.5 to 6% of your total return coming from income. So it's an important feature of your total return that has recovered. So with that, I'll stop there and see if there are any questions. I've been joined by Darren Thompson, our Head of Asset Management, and Chris Haynes, Head of Equities, also to answer any questions you may have. I've got one question here, which I might throw to Darren. Do you ever see things like cryptocurrency being part of the financial asset strategies in the future?
Thanks, Grant. And look, hopefully we get a few more questions through, but thank you for that presentation. On the crypto side, look, absolutely, we look at crypto and we think about it. What I would say, just as an overarching comment, is that notwithstanding our age, we sometimes get commented upon that we're an experienced investment team. That doesn't preclude us from looking at disruptive technologies and new asset classes. But it does give us an experience around looking to evaluate those from an investment case perspective. So where we would see crypto sitting at the moment in terms of its evolution is that, I think, step back and look at most of the clients we manage money for, we're looking to identify robust, strong, growing companies with good cash flows that produce good income streams. In many cases, the crypto asset class doesn't have those characteristics at the present time. We certainly think there are business case uses for blockchain and certain elements in the crypto space. But in terms of the currencies themselves, they're quite speculative, very volatile. And at this point, they don't, in our view, represent an appropriate risk-return framework for our client base and within our asset classes. But we continue to monitor that. You know, in terms of thinking around it, Web 3.0 companies that are evolving and will disrupt other technologies, where we're certainly aware of that. And where we probably have some adjacent exposure would be through potential investments like our EQT8-based global fund, which are looking at industries that are growing and that might be servicing those industries, you know, like the equivalent of the picks and shovels to the mining company, but where they provide the infrastructure. They're more than likely to be the investment cases that we're likely to invest in the near term, rather than investing in the cryptocurrency themselves in the short term.
Thanks, Darren. There's no other questions that I can see at this particular point in time. Just give it another sort of 10 or 15 seconds to see if there's any other final questions. Otherwise, we might wrap it up there to keep it short and succinct.
Sounds like your presentation was so expansive and authoritative, Grant, that it's answered everyone's questions. So well done.
Thank you. No other questions have come through, so we'll leave it at that. Thanks everyone, very much everyone, for joining us today. I hope you found that of use. And again, we'll look to do another presentation like this every 6 months, but also be looking to feature ad hoc webinars and presentations when there's an interesting thematic or important market drivers to talk about. Thanks very much for your time.